what I decided I want to do today is basically spend time on finishing up a couple more things for the model and talking about what you need to do in Monday's presentation. And somebody came by my office hours this morning asking about the multiples analysis, which they were struggling with, which I assume that means the other groups are probably struggling with as all. So we're going to talk more about the multiples analysis and the couple sanity checks. So a couple miscellaneous things. If you remember, there's a homework assignment this week that's due on Monday. And so what I'm just going to do is I'm just going to gift that to everybody. So everybody just gets whatever the points are. There is no homework assignment for Monday. So congratulations. Now, it doesn't mean that you don't have a lot of work, because obviously you have to work on your group projects for Monday, and you have to finish those. All right. Second, when I was looking at the 4 solutions files, which I posted solutions for Microsoft, Google, and Facebook, a couple things. One, Facebook, whoever did Facebook was going to have a problem because, as they said over the weekend, and I looked at it, 2 of their historical years just didn't have balancing balance sheets. And so you could have tried to make them balance and done your best guess, but practically with the data that we actually had from Bloomberg, there's no way you would have gotten the model to balance historically. So therefore, all that's going to matter is if you got the final 3 years to balance and the future years, but if the historical years didn't balance, I'm not going to worry about that because that's not your fault. There's nothing you could do. Now, if you actually were able to go in and jury-rig Facebook's balance sheet to balance, I'm not going to hold that against you, but this exercise turned out to be far harder than I thought it would have been. It would have been much better if we had done like, Starbucks, which had very reasonable numbers as opposed to some of these crazy numbers that we're seeing. Same thing with Samsung. Samsung turned out to be, did anybody here in this section do Samsung? Try to do Samsung? All right. Well, that's good because Samsung was even harder because their numbers don't make any sense. And you would have had a lot of trouble with Samsung. So again, if you do Samsung, I won't hold that one against you, and I would have just given you credit in the grading side. So Microsoft and Google, much easier. By the way, I had sent that announcement for the fix of the typo in the model. Just FYI, that was actually my bad. When I switched from, remember, Bloomberg switched the standardized format, and we were just doing the fields out of the model. And I added one of the new fields in that I gave to you. I just referred to the wrong year. Instead of referring to cell C, I referred to cell B. And when I carried that over, that caused the model to be out of balance. So thank you for whoever found it, pointing that one out. But that's why if you apply that fix, everything should be working in the model. So long story short, that fix I posted as the solution for Google. So if you want to look at a fixed model with all the things that you need, the Google file in the Files section under Canvas, under Valuation Model, there's a file called Google Model Final.xlsx, and the as-is. That has kind of all the fixes plus what we're going to do today in it. Okay? So that's the one you're welcome to use. If you did in your model, obviously you're welcome to use your model, but you had to make sure you apply those fixes. All right. So as I said, what I really do want to spend time on, though, today is making sure that we go back and deal with the issues that we need to do for Monday. Because remember, Monday you're going to do your group PowerPoint project. So make sure you turn in a copy of that PowerPoint file by 10 a.m., right? You'll turn it in as a group. So if one of your group members has to upload it on behalf of the group. But again, don't forget to do that. Then you'll have 10 minutes when you get to class to present. Again, you'll be in a timer. You have to cover all 4 sections. So we want to talk about that. But I want to start out by focusing on that final section, which is going to be the valuation section and what you need to do there. So first, you're going to talk about the as-is and final. So you're going to say something like, all right, I'm doing XYZ company. Their current share price is this. My target share price is this. I think they're going to be a buy, sell, or hold. Part of the way that we got the current share price is we basically had to make these assumptions for G, ROIC, margin based on what we saw in the multiple data. And to get to the final share price, we decided to change it for these reasons. And then you're going to have 2 sanity checks, right? And that's what I want to go back and talk about, those 2 sanity checks. So what I'm going to do is I'm going to take the Google model and I'm going to talk about the two sanity checks. So this is the Google model that I posted, and it actually includes them. So I'm just going to recreate them on two separate tabs. So I'll call this section 201. So first sanity check is the ROIC chart. Okay. So again, what we're going to do is we're going to go to the EPEOY tab. We're going to take row 15 and we're just going to chart that. And you're either going to add it as a chart sheet or you can add as a chart to a sheet. But basically, we're going to make this a line chart. So in this case, I'll make it as a new chart sheet and I'll make it a line chart. And what I want to do is I want to make sure I know the years. So I'll select my data and I'll come in here. I'll label the x-axis. See which year's which. But I basically have a chart of historical and future ROIC for a company. Right? Now, as I said, the reason why we're doing a sanity check is we're eventually going to be forecasting a stock price. And we just want to know is what we're forecasting reasonable. And it's hard when we're predicting the future to know what is reasonable. So one of the ways to help us answer that question is we're going to look at this ROIC line chart. And what we know for most companies is we would expect that over longer periods of time, ROIC should regress towards your cost of capital. That's what McKinsey showed us in the book based on their historical analysis of data. And that's kind of what we learned in Economics 101, that over time, industries earn their cost of capital. So therefore, we should expect regression towards that cost of capital, regression to the average of the industry mean. So when I see in the out years in particular a big dramatic improvement in ROIC, I need to be skeptical. Right? As I said, in finance, this is called a hockey stick. Performance goes down, then suddenly it starts spiking up again. This is not what I would expect. So if I'm valuing a company like Google, I should immediately be skeptical if my valuation starts going way up in the out years, unless I have a rationale for this. Now, if I have a rationale for this, it's okay, but I have to have an explanation. Now, here's the interesting thing. Google is an exception, and I do have a rationale for why it would go up. And it goes back to what we talked about on Monday. What did we say changed about Google on Monday? Yeah. They got rid of Motorola. Sprint Motorola. It was Motorola. So they had previously owned Motorola, hardware company, lower margin, lower return, and they no longer have that as part of their business. So here's the idea. Even when we looked at the ratios, that's why the analyst predicted a big jump in EBITDA margin. Right? So it's not suddenly that Google's going to do better with their business. It's just on a weighted average basis. If I get rid of the low margin stuff, then the rest of my business actually does pretty well. So they have much higher EBITDA margins on a go-forward basis, which means they also got rid of a lot of assets. Hence, they're going to have a much higher expected ROIC with a lot less assets and a lot higher margin. So in Google's case, is it unreasonable to have this ROIC chart? And the answer is no. Because really, if you think about it, this was the purchase of Motorola. It killed their ROIC. They ditched Motorola. It goes back to where they were before they had Motorola as a software business. So when I do look at their as-is, this one actually makes sense to me. If this were a different company, like let's say this is, I don't know, McDonald's, right? And if suddenly McDonald's does a whole lot better, given everything we talked about when we were looking at McDonald's, and they go from 30% to 50% ROIC in the future, I'd be a lot more skeptical about that one. All right. So again, it's just a way of making sure that we have a future that is representative of what should actually happen. Not saying it's even impossible for McDonald's, but it'd be a lot harder to explain them going from 30 to 50% than Google, because I can at least see a rationale. So part of what you're going to have to do in your valuation is you're going to take a screenshot of this chart. It's going to be in your PowerPoint presentation. When you get to this section, you're going to put up this screenshot, and you have to tell me why this makes sense. And as I mentioned before, what somebody did last year, and I thought that this was pretty cool, is they actually had the as-is ROIC chart next to the final valuation ROIC chart, so they could talk about the difference to explain why the final was different versus what the as-is was. So it actually helped them further clarify their final valuation. So that's what I would recommend for the first sanity check. And again, you should do this outside of this class in general if you ever start getting into real valuation stuff. So it's a good thing to think about in terms of your model. Second sanity check, and this ties into the multiples. So this is the key. If I go back to Google, and unfortunately for Google, it's going to make it a little bit more difficult to match up today versus last Wednesday because something just happened to Google which caused their share price to go down relatively dramatically in the last week. Because when we did the valuation last week, their share price was kind of higher and then it's plummeted recently. And you know why the share price of Google's dropped dramatically here in the last few days? Yeah.
I think it's Europe where they were.
But, no, it's near you.
In Europe, they are bringing not formal charges, but an investigation.
Yeah, so there's an announcement that the EU is going to do an antitrust investigation of Google, and then the market's like, uh-oh. So suddenly Google stock is trading lower. So I only say that because there's a reason why Google stock is going lower, but to do the multiples analysis today versus the as-is valuation a week ago is actually going to make the multiples change. Right? So just be aware of that as I show you some of the data, that there are some changes in the multiples because their stock price was like 540 and now it's down to 530. So therefore, 543 to 530, that change in stock price is going to lower the multiples. But that being said, here's the multiple analysis on the RV section for Google. Again, Bloomberg peers are the ones you're going to use, and probably country of domicile, just to keep the list manageable. So these are the U.S. tech peers by the default list. Now, again, in the custom screen, we had set up a multiples template. So this was the multiples template that we had created earlier this semester, and this is the one that you want to use. So what I'm going to suggest here is rather than taking a screenshot, to dump this to Excel. So I'm going to click Output, Excel. And I'm going to save this as Google multiple, and this is section 201, so I'll call it 201. All right, so then what I'm going to do is I'm going to come back to our valuation model for Google, and I'm going to import this as a new tab at the end. So basically, what I'm going to do is I'm going to open up what I just exported, and I'm going to right-click, move or copy, take it to the valuation model, put it at the end, move it to the end, hit OK. So I basically brought it into my valuation model spreadsheet. And then I'm going to name it multiples. Now I'd done this in the previous class, so I'm going to call this multiples 2, but basically call it multiples. All right. So this is the data that I export. I'll make it a little bit bigger so it's easier to see. And then what I'm also going to do is I'm going to add a couple of rows, 3 rows up here. No, wrong way. Undo, delete. I'm going to insert a few rows up here up front, so it's actually on row 4. Now, here's the idea, is I have the multiples for Google and its peers, and therefore the industry multiples today. Now, I'm going to be doing a final valuation with a final target price as part of my valuation process. So again, as a sanity check, that final valuation, which is going to be a DCF valuation, is essentially going to create the concept of a multiple. Because I have an enterprise value, right? I have an EBITDA in my model. So therefore, I could take my forecasted enterprise value divided by my forecasted EBITDA and get a forecasted enterprise value to EBITDA. I have my forecasted enterprise value. I have my forecasted sales. Therefore, I can get a forecasted enterprise value to sales in my model. So that's the point. What I'm going to do, just conceptually, is that my model, okay, so that's the key here, my model is going to give me a forecast for these multiples, right? And then I'm going to have the actual multiples from the real world. So here's the thing. When I change the final valuation, it's going to change the multiples. So what I want to do is I want to look at the multiple that's created by my forecasted share price of the model, and I want to compare it against what I see in the real world. And that's my second, what I'll call sanity check on my valuation. Because if I come up with a target stock price that has a multiple that's far different than what I see out here in the real world, then I got to really question how I came up with that valuation. If I come up with something that seems reasonable given what I see in the real world, then I'm going to be much more comfortable that that's a realistic valuation. So it's just another way of just providing an additional layering check on our model, because essentially what this represents is expected growth and spreads, therefore returns, for all of these companies. So my model, I'm putting in my guesses for growth and return. So what I'm really just trying to make sure of is that my guesses for growth and return are not completely unrealistic based on the actual guesses that people are using for these companies. So that's kind of the process that we're about to go through. Now, let's start out. The first ratio is enterprise value to sales. Next year's sales is 2016 sales. So in this case, what I need to do is I need to make sure I get the enterprise value for my model and next year's sales for my model. So here's the thing. The enterprise value is on my DCF tab. That is the enterprise value that we calculated, right? Now, here's the thing. Bloomberg is giving me the EV to sales that I'm actually using for my multiple. So I have to go back and I have to see Bloomberg's EV to sales. Type in FA, go to the enterprise value tab, and this is the calculation of enterprise value that Bloomberg is making for Google. What's interesting is the definition of enterprise value that Google and many people in the market use is actually slightly different than the one that we have in our model. So if I'm going to calculate an enterprise value to sales in my model, I need to make sure it's the same enterprise value to sales that I'm pulling out of Bloomberg so I can actually compare an apple to an apple. Otherwise, I'm going to be looking at an apple and a pear, right? So basically, here's the thing. How do we calculate enterprise value? Well, we said 1 plus 2 equals 3 plus 4, which means operating plus non-operating equals enterprise value, and that equals debt plus equity. Okay? What Bloomberg is doing is they're saying enterprise value is debt plus equity minus cash. Right? We're saying debt plus equity equals enterprise value. Bloomberg is saying debt plus equity minus cash equals enterprise value. Obviously, they're not the same things. So before we make the adjustment, I just want to make sure everybody understands conceptually. What are they doing? Why are they doing it this way? Another way of calling this is net debt. What you also know my opinion on net debt is I don't like net debt because you can't technically pay all your cash out to the bondholders. But nonetheless, that's what people do with net debt. So it's net debt, debt minus cash, plus equity. That's the definition of enterprise value that they're using. How does that translate to our version? What would we call that? Or by proxy, what's closer to what we would call, what they call enterprise value in our model? Debt plus equity minus cash. What's that closer to? Here's our DCF model. It's the process we followed all semester long. Debt plus equity minus cash. Conceptually, what does that really represent in our words? The operating value. So with the rest of the world, professionals out there, including Bloomberg, call enterprise value conceptually is closer to what the Digliani-Miller model would say is the operating value. Right? Now, again, you have to understand that Bloomberg started 1981. And back in the old days, in the early 1980s, when modern corporate finance was still very young, the world was a simpler place. And the PhDs that were doing the initial definitions that came out of Chicago and some of the top schools were looking at companies that weren't like the tech companies today, that had joint ventures with everybody, and biotech companies with joint ventures and cross-ownership stakes and all this other stuff. Most companies had much more simplistic statements. So when they came up with the definition of enterprise value, what they were really saying is it's the enterprise value minus the non-operating value. And the big non-operating value at the time for most companies was just having cash in the bank. So that was where net debt got born. That's where the initial definition of enterprise value is, which is we call more of the operating value, is take the enterprise value, pay off the debt. What must be left, take out the excess cash, is the operating value. Okay, so we would call that operating value, except notice that our definition of operating value includes investments and other miscellaneous stuff. And I'm just saying, historically, companies didn't have as much of that, and simplifying it, that's what they were trying to represent. But nonetheless, that's the definition that's persisted, and that's the definition that's used out there today. So it's not a question of whether it's right or wrong, but I'm saying conceptually, what I want you to understand is what somebody just answered, that this is really conceptually the operating value of the firm, even though we're calling it the enterprise value of the firm, because they're subtracting the big non-operating asset. Okay, so it also means that the enterprise value is subject to distortion, because what would distort the Bloomberg enterprise value today? Well, it's subtracting out the excess cash, so there is accounting for that. But what would distort it? Things. These other non-operating assets are what makes the Bloomberg enterprise value subject to distortion, right? Because basically it's assuming that the companies don't have a lot of this stuff if it's the operating values across the companies. And we know that when you have other non-operating values that could cause distortion. So again, conceptually it's the operating value. So what we have to do in our model, and this is what I want to do in the DCF tab, is I created something I call the Bloomberg equivalent value. The Bloomberg enterprise value, or BEV, for lack of a better term. So how would Bloomberg calculate enterprise value using our model? So what Bloomberg does is they take the debt and the equity, it's right here, and they subtract all of the cash. So that's what I'm going to do here. I'm going to take equals our enterprise value, the value of the debt and the equity, minus, and they don't just subtract the excess cash, they actually subtract all of the cash. So to be consistent, I'm going to go back to the balance sheet, 2014, and subtract out all of the cash. I'm going to subtract out the operating cash and what we would call the excess cash. So that's what would be the Bloomberg equivalent enterprise value in our model, as opposed to our theoretically correct enterprise value that matches Modigliani-Miller. Questions about what I just did? All right, so here's how this applies. I come back to the multiples. EV to sales equals, from the model, this is the model forecasted EV, divided by income tab 2016, because we're doing forward sales, 2016 forward sales, which was the earnings estimates, 4.29. Now, it's a little different today because Google stock price has gone down because of the EU investigation versus last week. But if you look at the assumptions tab, it was 4.28 last Friday. All right. So basically 4.28, 4.29, I would expect these numbers to be very similar because I'm trying to replicate in the model the as-is valuation. Based on the as-is valuation, I should essentially get the same multiple. So that's the point. If my model has the as-is valuation, I would expect the multiple that I have in here to be very similar to the multiple that sees trading in the real world. Right? Now, here's what will happen. When we do the final valuation, obviously it will change, and that's where we're going to see if it makes sense. So the point of this exercise is not to replicate the multiples in the model. The point of this is to replicate multiples that the model valuation will give us in the final target and to see if they make sense. All right, but I'm just right now just kind of creating it. Since I've done an as-is of Google, I'm going to be relatively close. All right, same thing. Enterprise value to EBITDA. All right, so what am I going to do here? Equals enterprise value off the Bloomberg equivalent enterprise value divided by, from the income tab, 2016 forecasted EBITDA. That would be 9.06. Again, a little lower today because the share price has gone down with the EU investigation, but I'd be willing to bet it would be very close to 9.06 last week. Right? Enterprise value to EBIT equals DCF, Bloomberg EV divided by income tab, 2016 EBIT, which we're calling operating income, so it's I-10, price to earnings multiple equals price per share divided by net income per share. Well, take out shares, price divided by net income. What is price? Equals, from our, again, DCF valuation, we have an equity value. Go to the income statement, 2016 forecasted net income. Forecasted PE. Right? Now, we don't really have a PEG ratio in our model because we're not really forecasting a long-term growth of earnings per share. Right? We're forecasting a growth of cash flow, not EPS, and the PEG is based on growth in earnings. So we're not going to really create a PEG ratio in our model. But price to book, price per share divided by book value per share. Therefore, net income, price per share is the equity value divided by the book value. So equals DCF, equity value divided by balance sheet. Historical book value would be the 2014, and it's common equity, so that would be the share capital plus retained earnings. So actually I want to add those two together, so I'll make this a parentheses. 2014, which is column G, 29 and 30. So G29 plus G30. Okay, so around 3.54 would be their price to book. All right, so let me just give you an example of how this would apply. So I go in here and I'm trying to do my final valuation of Google. And I come in here and I say, you know what? It's just going to be Armageddon with the EU. All right, they're just going to destroy this great company and they're just going to tear them apart. So I think revenue is going to fall 30% a year. Now, I don't really think that, but let's say they do, right? And their margins are going to start to plummet. And their share price is $200 versus $500, right? Get out of Google right now. Well, what does that mean for multiples? That would mean that their EV to EBITDA would be 2.4. Even AOL, which is the basket case of the industry, is trading at 5.7. Is that realistic? Probably not. That's what I'm saying. This is how we're going to use this. We're going to do a sanity check, and we're going to say, that's not realistic. Their share price isn't going to trade times 2 point EBITDA. There's probably nothing the EU is going to do to them that's going to cause that to happen. So this is not a share price that would make any sense. So that's what we're really just trying to do. But let's just say I come in here and I make my changes. And I'm actually bullish on Google. I say, you know what? Not much is going to happen here. I actually think they're probably going to grow at 12% a year. I think that their margins might stay close to 47 and 10 and 8. And oh, by the way, I think longer term, Google's going to grow faster than what their multiple suggests. I think they'll grow with the economy at about 3% because they're going to find ways to innovate and continue to grow. So I come in here and I say, you know what? I really think Google's a buy. Right? Now, I come over here to my multiples. And what that means is Google would be trading at a multiple of about 11 times EBITDA and a multiple about 13 times EBIT. Now, it's much higher than they are today, but you know what? If I look at the industry is at 13 and 20, so that doesn't look unreasonable. If I look at Facebook, Facebook's at 16 and 19. That doesn't look too unreasonable to me. So I'm not saying this is the right answer, but at least I'm doing something that's in the bound of what I see other companies trading at. So this is not out of the realm of possibility that this could happen. So that's the way that I'm using this as a sanity check. Questions? This is what you got to do on Monday. Yes?
For the PE multiple for 2 years, you divided it by net income.
Yeah, so basically it's the price per share divided by the earnings per share. Take shares out. They both cancel out. It's the price per share, which is the equity value, divided by the net income. And since we're doing the forward 2 years in Bloomberg, we got to do the forward 2 years in our model, so therefore 2016. So we got to be consistent. Because if I did today's net income and I did the forward PE in the model from Bloomberg, then I would not be looking at the right answer. That causes a problem. Questions? Yes?
I was looking at the multiples that were imputed for the final for Google that you posted, and they're like unreasonably low.
Probably because I had created this and saved it and uploaded it.
Oh, okay.
So I was doing the same example in the previous class. So maybe I'll replace it with something more realistic. But that's probably why, because I was playing around with it just to show them examples of what didn't make sense. Right? But the formulas are in there, and that's what's more important.
That's like at -30%.
Yeah. Yeah, but I'm saying, but I did put the formulas. Everything I did was uploaded, so that way you don't have to recreate this. Now, if you want to, go ahead, but you're welcome to use this as the file to help you, so you don't have to recreate all the math. But I want you to understand why the math is doing what the math is doing. So let's go back. You have 2.5 minutes approximately to do each section. So the valuation, I got 2.5 minutes. So I'm doing my valuation of Google, right? So basically, here's what I'll say. I'll say as of April 8th, Google was trading at about $5.43 a share. Based on that share price, I think Google is worth, start the clock again. I think Google's worth $6.35. Therefore, I'm going to put a buy on Google. To get the $5.30 a share price, we had estimated a G of a little over 1%. We had estimated an increase in margin of 47% because they sold Motorola. And given the industry growth rates as a mature company, they were probably growing around 10% to 8%. And then essentially what I believe is the reason they're a buy is because I think the market's underestimating how much growth that Google would have, particularly in the long term. I think the G should be closer to 3% because they're not just growing in the US, they're growing globally. I think that the margins are actually potentially being higher because now that they're just more of a pure software business, that allows them to get much higher margins. I'm seeing that with other companies like Facebook. I also think that Google's growth rate in the next 5 years is also going to be higher because they're innovating into all these new technologies, Nest, etc., and that's going to allow them to grow at 8 to 10% and 12%, which gives them a target share price around $6.40 a share. So I put a buy on Google. For my sanity check, I did an ROIC chart, and based on the chart, I'm seeing an increase in their ROIC, but I can explain this because even in the out years it's going up, which is not what I would expect. It's going up because they ditched Motorola. This was the acquisition of Motorola, which killed their ROIC. They ditched all the assets. They got out of the low margin business. And so even though I wouldn't normally expect it, in this case, they're really kind of going back to the core software business where they were. So I actually think that this is reasonable. And given the multiples of Google, Google would be trading at about 11 times EBITDA, 13 times EBIT, and an 18 PE, which is actually still below the industry average of the software group and well within the multiple range. So I put Google at a buy. I don't know if anybody timed me, but was that around 2.5 minutes? Maybe less? There you go. Section 4. Recorded on video, posted on YouTube. So I'm not saying make this a Mad Lib and exactly say what I said, but this is a flavor of what I want you to do in your presentations on Monday, right? And one of the couple things that I did in there that I want you to do is I referred to specific numbers, right? And there's a reason why I want you to refer to specific numbers, because if you just tell me Google's overvalued because I think that their price is too high, like that's a meaningless statement. And if you say that their growth rate should be lower, to me, that's a meaningless statement as well. Lower than what? So by giving actual numbers and referring that, one, it will add to your credibility long term. As finance majors, finance professionals, you should be in the habit of using the data to help you essentially give your case, as opposed to just stating assertions. And number two, it will help me and help the person listening to you understand what you're really talking about. Because, for example, with growth, there's a long-term growth rate here, which is growth in earnings per share. There's a CVG in our model. There's growth in revenue. You just say growth. Which growth are you really talking about? So by referring to and saying I'm talking about the G, then I know which growth you're talking about, 1 to 3%. I'm not thinking that you're talking about revenue growth. So by referring to numbers, it helps the person that's listening to you understand what you're actually saying, and gives you credibility as to why you're making the assumptions. So that's why it's very important in all of your sections of your paper, all of your sections of your PowerPoints, to make sure that you're referring to numbers as you go along. Questions about any of that? All right, that's section 4. As I said, this morning I had somebody come to my office hours, and what she basically said is she wanted some clarification because she was a little confused on what needed to be done in the multiple section, section 3. So I think everybody else probably that's working on section 3, which is the multiple sections, probably like, what do I got to cover? How is that different than section 4? What do we need to do? So I want to make sure we all understand that. So by the way, since this is essentially the data that I just took out of the RV screen, I'm going to actually use this spreadsheet. So you can give me the screenshot. If you use the model, you can give me an example of this. But basically, you got to explain this. So what I want you to do using these 6 multiples and the 6 multiples that you got to talk about are EV to sales, EV to EBITDA, EV to EBIT, PE, PEG, and price to book. I want you to tell me why your company, in this case Google, is trading at a premium or discount to the industry average. Then I want you to talk about at least a couple of other companies. Right? The reason I want you to talk about a couple of other companies is that the compare and contrast helps me make sure that you understand the whys. Why are things different? Right? Because you can't just say the multiple is the multiple because it was an average of all the other companies. That is a meaningless statement. Right? There's got to be a rationale for why a company's trading different than the industry. So what is the rationale? Well, again, remember, what you're looking at on the screen in front of you is the result of essentially the key value drivers formula. Right? It's the KVD that gives you this answer. So a multiple analysis is just working backwards. I'm seeing an answer, and just like in the as-is valuation, we were trying to guess what the market must have been thinking of some of the assumptions. We're doing the same thing with the multiples. What were the assumptions that were put into the KVD that led to these multiples? So if we think about the key value drivers formula, 3 primary things that drove multiples, maybe 4 depending on the rearranged math. 1 was the ROIC. 2 was the cost of the capital. 3 was the growth rate. Those were the 3 things that drove multiples. When we rearrange to do EV to EBIT, the 4th is the tax rate. Okay, so ROIC, cost of capital, growth, tax rate explain multiples. That's what you're explaining to me. Those are the 4 ingredients. So here's one of the assumptions we'll make. If everybody's in the same industry, the tax rate should probably be similar. So tax rate's probably not a differentiating factor, but notice I'm saying probably. If Google and Apple have tax rates of 14% and I'm comparing it with a company that only sells stuff in the US, well, their tax rate's probably going to be 35%. They're probably not going to have a 14% tax rate. So that's going to cause them to be at a different multiple, probably a lower multiple, all things being equal. So that's what I mean. I need to understand the company I'm looking at, but if they're global, like Google and Apple, then they're probably going to have some more tax rates. So therefore, I'm probably not going to make that a discriminating factor in the multiples. Same thing with non-operating items. I assume most companies have similar or not at all operating items, non-operating items. So therefore, I take that off the table. Outside of cash, which has already been adjusted for, if they don't have a lot of non-operating items, then that's not going to be a discriminating factor. If they do and other people don't, that could change things. I got to be aware of that. But most people in multiple analysis assume the non-operatings don't apply. So if I assume the non-operatings don't apply, and if I assume that the tax rates are similar, then really it's growth and spread. This is a representation of growth and spread. Now again, most companies plus or minus 1% typically have similar cost of capitals. Assuming that's the case, ROIC and growth. So one way to start this is just to say, this is just a representation of growth and ROIC 6 different ways. That is what I'm looking at, and that is what I'm trying to understand. So let's start out, and we'll say the first ratio, EV to sales, also gives us some insight into margin, because we know what the estimated margin is for, in my case, the company, and that is the EV to sales divided by the EV to EBIT. That's the estimated margin for Google. And for the industry, we know that is that divided by that. So one of the other things that we know as we do the multiples is Google is expected to have a higher margin than the average company in this industry. Okay? So that's the first thing we know right off the bat as we do the multiple analysis. Next, we want to figure out the growth in the ROIC. So again, PEG ratio. PEG ratio is the PE divided by the growth rate. Right? Why would I pay more for growth? Two companies have the same growth rate. Why would I pay more for one versus the other? Yeah.
ROIC.
Exactly. Because I'm going to get more free cash flow, proxy ROIC, for the same growth rate, therefore I pay more for it. So PEG is the purest representation of expected ROIC of the 6 multiples. So generally, higher PEGs typically mean higher expected ROIC, or at least higher spreads. Right? So in this case, looking at this data, Google is trading at a discount lower than the industry in the PEG. So what can we assume about Google's expected ROIC to this industry peer group? It's lower. Right? Now, next, LTG. This is 5-year growth rate in earnings per share. G in our models is growth in free cash flow forever. Like 1,000 years compound annual growth. It's not the same thing. In fact, it's not the growth in sales. G is growth in free cash flow. Here, it's growth in earnings. Now, directionally, we're going to make an assumption that the growth in earnings is at least a directional proxy to the growth in free cash flow. It's not the same number, but at least it's directionally. Now, again, they could be different, but let's assume it's not. Who's growing faster, Google or the market? Market. So Google has lower growth, and what can we say about their ROIC? Lower ROIC. Therefore, they're trading at a discount to EBITDA, EBIT, and PE. That's what I want you to understand. Yes?
Did you say the long-term growth rate in the far right column, that's representative of continued value or over the next 5 years?
No, the far right on this one is 5-year growth in earnings per share. Here, in the assumptions tab, this is growth here of free cash flow into perpetuity. And again, I've gotten questions about this, so I know that this is confusing because we're throwing a lot of growth rates around. And by the way, that's why I want you to be very specific about the numbers you refer to. Because when you say growth, there's growth in revenue, there's growth in earnings, there's growth in cash flow, there's lots of different growth rates. So I want you to be very specific about which growth rate you're talking about. In this case, we're saying what I really care about in the key value drivers formula is this number. But what I'm doing is I don't have this number because I could estimate it for every company and that would require more work. But right now, since I don't have that, what I at least have is I have a guesstimate of the growth in earnings, which I'm going to say is a proxy. So I got to plug my computer in before it dies. It's a proxy, and so therefore it looks like the market's growing faster than Google, so I assume the cash flow is probably similar. So at least trend, Google lower growth, Google less ROIC, Google has lower EV, EBIT, EBITDA, and price to earnings. That all is consistent, makes sense, makes logical sense to me. So that's how I can explain Google. Does everybody see what we just did? Understand the logic and rationale. All right, you practice on Facebook. So here's Facebook. I'm going to give you 3 or 4 minutes. And I want you guys to talk about yourselves or look at it yourself. And you do the same analysis for Facebook. Why is Facebook trading at a premium or discount, and why? What do you think? So I'll give you a couple minutes, think about it, and then we'll try and answer that question. And again, it's not to Google, it's to the market cap weighted average. So Google, we said, is trading at a discount to the average. Facebook, premium or discount to the average. Why? In about 3 or 4 minutes.
sales per EV. I mean, the sales per EV. Since they're EV to not margins, those big stuff. Right, so 20 margins goes over the 60%. Price to book is above industry. I guess makes sense. There's margins, and they have higher growth in the industry. That's what estimated long-term growth EPS rate on the upper end.
All right, do we have an answer for Facebook? What's the answer for Facebook? Are you scratching, or do you have an answer?
No, I don't.
Okay. Yes.
Basically, they're trading above the market average because they have just a slightly lower expected ROIC, but they have.
Sorry, stop you. How do you know that?
Because their PEG ratio is a little bit below the market weighted average.
And how do you know that?
That it's below.
Yeah.
Because it's 1.07 compared to 1.32.
Thank you.
Average.
Sorry.
And then they have a higher 5-year expected earnings growth because at 30.28, they're higher than the market average of 22.21.
At this point, because there's enough of a spread, you could say 30 versus 22, but okay.
22. And that's why their EBITDA and EV sales and whatnot are trading at a premium.
Great. And then the only other thing is, did anybody do the margin of Facebook versus the industry? What was it? 51%. I mean, I hadn't looked at Facebook numbers until we did this little analysis last week. I mean, they're just gaudy. I mean, the growth they're getting, the margins they're getting, etc. But what's the primary reason that Facebook is doing better than Google? So now start thinking about relative rankings. Yeah.
According to the multiple analysis,
Yeah.
They just have a higher expected earnings growth in the next 5 years. I feel like the biggest differentiator.
Exactly. It's all the growth. And part of it is just percentages. Remember, multiples are based on percentages. And Google, law of large numbers, is a much bigger company, which means their percentages growth are lower. Facebook is a smaller company. It's got a lot more room to grow. That's why I'm paying more for the future earnings. It's not just the magnitude of the earnings. It's the percentages that are driving the multiples. And therefore, I'm paying a bigger multiple for that higher percentage growth. Does that make sense to everybody? Okay. Now, I'm going to give you a hard one. Right? Because this is an example of something that doesn't make any logical sense given the analysis tools that I just gave you. Yahoo. Explain Yahoo. So again, I'll give you a couple minutes to figure it out. But I'll give you a hint. Something happened with Yahoo within the last 12 months that would affect and distort these multiples. So that's the hint that I'll give you. But I'll give you a couple minutes. Talk about Yahoo. Premium or discount and why. All right. What do you think about Yahoo? Premium or discount? Yeah, go ahead. Definitely premium. Why? What's the distortion? You know? It was Alibaba. So Yahoo, a number of years ago, bought a 30% stake in Alibaba. Alibaba went public and probably one of the most successful IPOs ever. Alibaba's worth a fortune. Yahoo is got 30% of that fortune. So that is distorting Yahoo's multiples, right? So basically, it's ridiculous to pay 85 times somebody's earnings next year for their company, right? Unless you're just a tiny startup with a bright future, and you have no earnings but all this value. But Yahoo is not a fast-growing company. We know that. Yahoo is a mature company. They're struggling. So why are people willing to pay so much? It's because they have this 30% of Alibaba that they're going to basically sell. They're going to get the cash for, and that's why Yahoo is valuable. So this is what I meant by distortion. So if you didn't know that and you tried to do this analysis, it just wouldn't make any sense to you, right? Because you'd be like, how could this company, and why would it not make any sense, by the way? What would have flagged that this doesn't make any sense? Yeah.
The margin's 9%.
Yeah, the margins are 9% if you did the margin analysis. What else wouldn't have made any sense?
The future growth is like half that of the...
Yeah, the future growth is like half of the industry. Yet they're trading at this ridiculous multiple. And at 9% margins with half the growth, like, how does this make sense? And the answer is it doesn't. And the only way it makes sense is if something else is going on, and the something else is they have 30% of another company that's doing really well. So that's what I mean by distortion with multiples. So, Google, Facebook, relatively clean. Not saying that they don't have stakes in other companies, but relatively clean. Easier to see the trends. Yahoo, much more difficult. Yeah.
Is the PEG ratio so high because it includes non-operating?
Exactly. The PE is the price, which includes the equity value. The equity value is inflated by the stake in Alibaba. That's why.
But usually would the PEG match up with the estimated margin, like the same, like the direct
Well,
ratio?
assuming that the productivity is similar, the pegs and the margins should start to match up. And that's what I mean, but that's why people often say, all right, margin's my proxy for ROIC. Right? Because everybody should have similar levels of productivity, so therefore margins, they're really a discriminator, so therefore higher margins should be better. Lower margins should be worse. Right? In this case, the lower margins for Yahoo should be a lot worse. And that's the point. If you actually looked at Yahoo, Yahoo's not growing. Their margin is terrible compared to most of their other firms in this industry. Right? And they basically, as a company, we know this, they don't really have any competitive advantage. And that's their problem. Yet they have this great valuation. So, as I said, if you take all that out, what you could probably say is Yahoo is not doing nearly as well as we would have expected. And so, therefore, this one is distorted. Right? Now, final one, LinkedIn. What do you think about LinkedIn? All right, anybody have any thought on that? Premium or discount for LinkedIn, and why? And I kind of surreptitiously went into the market cap field and just replaced that with the estimated margin for all the companies, just so you kind of get a sense of that. But what's going on with LinkedIn? Premium or discount? And by the way, primarily, every ratio is a premium or discount. Think about the earnings multiples. Premium or discount? EV to EBITDA, EV to EBIT. Go.
So the enterprise value multiples are trading at a premium,
Okay.
pretty significantly. Even the estimated margin is at 14.5%, which is kind of lower than what the market cap weighted average would seem to be. This can kind of be explained by the growth estimates. Looking over the price to book multiple, which is 9.7 compared to 6 for market cap weighted average. The market's estimating a significantly higher growth rate. This is also represented by the estimated long-term growth multiple as well, trading at almost twice at what the industry average is trading at. Even though LinkedIn isn't really expected to have a significant ROIC in relation to the industry, looking at the PEG ratio, it's pretty much in line with the industry average of 1.46 compared to 1.32. So this trading in premium can pretty much be explained by the expected growth rate being a lot higher for LinkedIn than pretty much any other company.
I'm glad we got that on video. Again, great. Perfect. That's the exact type of analysis you should be able to do. So that's exactly what I'm looking for because, and here's when we put the three together. So now we have some real insight that's going on amongst these firms. Why is Google trading at a discount? Low growth. Why is LinkedIn trading at such a high premium? Why is Facebook trading at a premium? I'm sorry? More growth and high margins. Okay? So I'm just saying it's not just this company's higher than that company. I mean, anybody can do that. But there should be at least now a little bit more insight as to why some are higher and why some are lower. And that's what I want you to understand. That's what these numbers are eventually going to tell you. Now, as I said, the more you do this, the more it starts to become almost second nature and obvious to you. But let's say I'm just talking to a company, or even I'm working at a trading desk. Like I need to be able to make quicker, assumptions than doing a very detailed DCF. So by having some insights into what the data is telling me, it helps me. Now here's the thing. In no case could we have absolutely said, here's the expected ROIC, here's the growth, and here's the return, because it's a combination of both that leads to the result. So that's why I said I have a relative idea of what they are. I don't know exactly what they are, but at least I kind of have a feel. So this should help me in two ways. One, when I do my valuation, it should help me with the valuation. So that's the point. If I'm valuing Google, I'm probably not going to do 20, 30% growth for Google in the next few years. Right? I already know the market's not expecting a lot of growth. I already know they're kind of big and it's law of large numbers. So it's probably going to tamper down my growth there. I don't know what it's going to tamper down, but it makes more sense that Google's not going to have a lot of growth. Same thing. If I were valuing LinkedIn, I probably would be expecting a lot of growth in the next few years. So doubling and tripling in size every couple of years, that's probably expected by the marketplace. So if I'm valuing them, I would expect my model to look that way, because that's the only way you justify this current price. So it kind of helps me when I start thinking through the types of assumptions I'm going to make on my valuation. So that's one of the reasons we do this. And then second is it's really an exercise from my perspective, and that's why I'm asking you to do more than one company, because by doing the deltas, it really starts explaining why one company's in one place and why another company's in another place. So that's why I'm asking you to do not just your company, but practice doing 2 or 3 when you go through your presentation. All right? Questions about any of that? So again, you have 2.5 minutes to complete this section. So what would I say in this section? Doing the multiples analysis for Google. I want you to understand that Google is trading at a discount of enterprise value to EBIT and EBITDA relative to its peers. Google has a lower EV to sales. Google has a lower EV to sales than the. Start this again. Google has a higher estimated margin than the industry, so therefore, it's having a lower multiple because it must have a lower ROIC. And I can see that the market's expecting a lower ROIC for Google because it has a PEG ratio of 0.97 against an industry of 1.32, and it has a growth rate of about 16% versus an industry growth rate of 22%. So it's the lower growth, lower expected ROIC that's actually hurting Google's multiples, which is why they're trading at a discount of EV to EBIT and EBITDA. When I compare that to Facebook, I see a little bit of a different story. With Facebook, I'm actually seeing them trading at a premium multiple, and primarily, if I look at their PEG ratio, their PEG's a little lower than the industry at 1.07, suggesting a little bit lower ROIC, but what Facebook has is an extremely high expected margin of about 51%, and a very high growth rate of 30% relative to the industry of 22%, which is causing Facebook to trade at a premium and a higher multiple. Finally, I want to talk about LinkedIn. LinkedIn has about the same ROIC and very similar PEG to the rest of the industry. Their margins are a little bit lower than the industry, 30% for the industry, but LinkedIn is closer to 15%. But what really is causing LinkedIn to trade at a premium is a very high growth rate. They're expected to grow at about double the industry, and that's why they're trading at a premium. Right? Outside of my pause there for a second, that's why I said it's perfectly okay to use no cards and help you in practice with this. Right? But other than that, that's what I'm looking for. And by the way, that ended up, even with my pause, taking about 2 or 3 minutes. So that's what you're going to talk about in 2.5 minutes on Monday. Questions? Yes.
So it says in like the thing you have 5 other companies. Do we need to talk about all 5, or do we just need to do like?
For the PowerPoint, you won't have time to go through 5.
Okay.
But what I'm telling you, the reason I want 5 is I don't want you to have just 3 companies in your multiple analysis. Like there's just not enough peers to really give an industry.
So
So-
the ones we think are most important.
Exactly. So I just say pick the ones that I think are most important, either what you consider to be more the direct competitors or the most interesting companies. And by the way, if a company has a bunch of NAs, obviously you probably don't want to talk about that one because then you just don't have enough information to talk about that one. So that's why, have some peers in the list. Now, by the way, when you get to the paper, I'm going to ask for a relative ranking of those ROICs. All right. So given these 3 companies, all right, let's just take Google, Facebook, and LinkedIn. Tell me which of those 3 companies probably has the highest ROIC. Google, Facebook, LinkedIn. Highest ROIC, expected ROIC. All right, so you think it's LinkedIn? All right, why?
Because they have the highest pay rate.
Okay, well, they have the highest growth rate, but you think they're going to have higher ROIC. Okay, so LinkedIn 1, who'd you put 2? And who'd you put 3? Okay, there you go. Now again, you probably did that mostly because of the PEG ratio. In this case, the PEGs are probably clean, so it's probably okay to do that. But that's the other thing I'd like to know, is that, what is attractive to LinkedIn, I think to a lot of investors, is because LinkedIn right now doesn't really require a lot of capital. And I basically have a basic business that has okay margins with almost no investment and huge astronomical growth. And that's why LinkedIn is suddenly becoming very valuable. And oh, by the way, what did LinkedIn just buy? It's probably going to hurt their ROIC a little bit. They just bought lynda.com for $1.5 billion a couple days ago. So LinkedIn is trying to become more relevant to you in the job market because not only will they help you get a job, but they'll now give you skills to help you, either if you're on the job or trying to get a job, develop some skills in your site. So they're expanding. They're basically trying to grow. They're probably going to grow even faster as they get into some of these other markets. But nonetheless, something else we could seed in with the examples if we were talking about LinkedIn. So pay attention to what's happening in the outside world for the companies that you're covering. Right? Because if there are news items about your company, I might ask you a question about them. And definitely when you get to the external people, they're going to ask you questions about the outside items and what it means. So if I'm doing Google, I needed to know that the EU is doing an antitrust thing. Because that's big news and really affected their share price. Okay. So again, 10 minutes, each of the 4 sections you got to cover. It'll be good. Don't panic. Everything will be fine. TAs have office hours tomorrow, and if you have any questions, you can also try and shoot me some emails. Okay, see everybody on Monday. And remember, the homework assignment, I'm just going to give you credit for. So there is no homework for this week, other than making sure your group project is ready for Monday. See everybody on Monday.